Hello, my name is Mike Sinibaldi and welcome to this week's video edition of Heard on the Street. In this edition, I'm going to take a look at the S&P and also revisit the chart of the gold-oil ratio and its implication on other markets. The first market I'm going to talk about is the S&P. On March 30th, I left readers with the following bullish interpretation, effectively changing my view to the alternate count, a very bullish count, even though the origin of what appeared to be wave 1 down had still not been exceeded by the rally that began on 3/16. Since then, I've changed the degree at the daily chart level. The implications are the same. As I stated in my March 30 post, the count does have its drawbacks, specifically wave 3 as indicated by the red line of wave 3 parentheses is shorter than wave 1 of wave 3 in parentheses. This implies that wave 1 of wave 3 in parentheses is extended. Extended first waves are rare, yet trying to find another acceptable interpretation also yields low probability count. With the daily count exhibiting problematic counts, I turned to the higher time frames to see if they would bring clarity to the count. At the monthly higher time frames of both the cash and E-minis, each exhibit a typical wave relationship between corrective waves, whereas wave C equals 0.618 of wave A. For the S&P cash market, this level is 1352.67, and for the E-mini, it's 1346.25. The weekly chart level of the E-minis counted well into that number, as wave C was an ending diagonal and the market topped just below that level. With that said, I think it's important to at least keep the bearish count as an alternative. However, the subsequent decline has not followed the wave personalities of a first wave after a terminal diagonal, i.e., that the decline should be swift and retrace to the origin of the pattern in approximately 1/3 of the time it took to build. While there are 6 weeks in time remaining to retrace the pattern, price is more problematic. The advance from 1241.50 has already retraced over 90% of the decline from 1343. Since second waves cannot exceed the origin of an impulse wave, the market can't rally more than 15.25 points, or the bearish alternative count is invalidated and the bullish interpretation will be deemed confirmed. Dropping to the intraday chart level, the following chart represents my best count at this juncture. The current decline from 1333.50 is most likely part of wave 4 circle that is still developing. For the overnight session or early on in Monday's daily session, I expect wave 4 to complete, then reach a new recovery high which lies just above the red dotted line or 1343. I recommend keeping an eye on the monthly resistance level cited in the E-mini and cash markets because the minimal requirement to complete the final wave up is a new recovery high. It's quite possible that stops could be run and the market rolls over at the same levels that I found significance before. Once wave 4 circle completes at the anticipated 0.236 to 0.382 retracement levels, 1318.75 or 1309.50, I'll calculate additional Fibonacci targets for the completion of wave 5 circle of wave 5. The final market that I'll cover in this week's edition of Heard on the Street is the gold-oil ratio. In the March 6, 2011 video edition of Heard on the Street, I featured this ratio and its implications for the US dollar, commodities, and equity markets. At the time of that video, the ratio stood at 13.6 and has made lower lows beyond the first two targets of 13.6 and 13.3 respectively, leaving the 1.618 extension or the 12.5 target on track. I recommend viewing my original video for further insight. You can find that post under the archive section of my blog at the bottom right hand side of the page. I hope you found this video helpful and best of trading.